Imagine waking up every morning to find your money has quietly grown overnight without you lifting a finger. Sounds like a dream, right? Well, welcome to the world of index fund investing, where your money works harder than you do, or does it? Dive into the ocean of investment, and you'll find two big fish swimming around: index funds and actively managed funds. Let's start with the former, the darling of passive investors everywhere. Index funds, the lazy investor's dream. Index funds are like the automatic cars of the investment world. You set it and forget it. They aim to mimic the performance of a specific index, like the S&P 500, which means your investment automatically includes a slice of all the companies in that index. Here's the beauty: low cost. These funds have lower expense ratios because they're not paying some hotshot fund manager to pick stocks. Less cost for you means more money stays in your pocket. Diversification. By tracking an index, you're spreading your risk across hundreds, sometimes thousands, of companies. It's like betting on the entire league instead of just one team. Consistency. Over long periods, index funds have shown they can match or even beat the market average. Why? Because the market, as a whole, tends to go up over time. But wait, it's not all sunshine and rainbows. Here come the cons. No outperformance. You won't beat the market. You'll just ride along with it. If the market tanks, so does your fund. Limited upside. Since they're tied to an index, you won't benefit from the exceptional performance of individual stocks or sectors outside that index. Boring. For thrill seekers, this might feel like watching paint dry. There's no adrenaline rush from picking winners or dodging losers. Now, let's flip the coin to look at actively managed funds. The Ferraris of the investment world. Actively managed funds. The high-octane option. Here, human fund managers flex their muscles, trying to outsmart the market with stock-picking prowess. Here's what they bring to the table: potential for higher returns. If they're good, really good, they can outperform the market, making your investment grow faster than a passive index fund. Flexibility. Managers can shift gears, moving into or out of sectors based on their predictions, potentially capitalizing on opportunities or avoiding downturns. But oh, the costs. Higher fees. You're paying for that expertise, and those fees can eat into your returns, especially if the fund doesn't outperform the market. Performance risk. If the manager's picks are duds, your investment could lag behind even the most basic index fund. Human error. No one's perfect. Even the best managers have off years, and when they do, your portfolio feels it. So, when do index funds shine? For the long haul. If you're in it for the long game, index funds are like setting your investment on autopilot, perfect for retirement accounts or wealth building over decades. Cost-conscious investors. If you're watching your wallet, the low fees of index funds mean more of your money is actually invested rather than paying for management. When you want peace of mind, less stress, less to watch. You're not jumping at every market twitch, but when might they not be your best choice? Short-term goals. If you're looking for quick gains, or if the market's in a downturn, an active manager might navigate the choppy waters better. Seeking alpha. If you're chasing that extra bit of return, or if you believe in the skill of a particular manager, an actively managed fund might be worth the risk. Niche markets. If your interest lies in sectors not well represented in broad indices like tech startups or green energy, an actively managed fund might give you the focus you need. In the end, the choice between lounging in the comfort of index funds or riding the roller coaster of actively managed funds comes down to your investment goals, risk tolerance, and how much control you want over your financial journey. So think about what kind of investor you are: a set-it-and-forget-it type, or a hands-on, market-beating dreamer. Your choice might just define your financial future. Ah, the sweet agony of choice.